Good evening to all friends, professional colleagues, investors and all participants. We at Arthveda welcome you all for this webinar on new AIF regulations, the Alternate Investment Fund, the implications for Ultra HNI investors and their advisors. I am Loknathan Nadar, heading the infrastructure sector at Arthveda Fund Management Company. Today, your moderator and webinar organizer. I am so pleased to be with you this evening and have the chance to introduce our guest speaker, Mr. Siddharth Shah. Siddharth is partner at Nishit Desai and Associates and the head of the firm's fund practice, an area in which India has unparalleled expertise and is a market leader. Siddharth has over 14 years of experience on advising clients on fund and fund-related matters. Now, this includes fund formation, fund structuring, organizing, documentations, everything related to fund, and also he takes care of secretarial and other practices. As a renowned expert, he is a frequent speaker at various domestic and international conferences. And to add, we have been working with Siddharth on various assignments. And I should say, Sid, you have been a great person to work with.
Thank you.
Siddharth, we are delighted to welcome you and look forward for your insights on the new AIF regulations and the implications that the regulations will have on the Ultra HNI investors. Friends, please help me to welcome Mr. Siddharth Shah. Over to you, Siddharth.
Thank you very much for the very kind introduction, and Nishit Desai Associates, I welcome all of you to this session. We've obviously, as a firm, been very actively involved in the fund space, and in many sense, to be fair, we've had the benefit of being pioneers in many sense on the funds in India. And it's been very exciting times for us where globally the fund environment has gone through its own ups and downs, and so is the case for Indian funds as well. And as an important participant in the industry, we've been very closely associated with this space. And we were very excited and are very excited to see the alternate investment fund regulations. Before I go into the specifics of the fund regulations, I would like to give about a minute or two of the background and the backdrop in which this whole development really happened. The first set of regulatory framework were for regulating what was traditionally known till recently as venture capital fund. That regulation was introduced in 1996, and it was in a very different environment where India was looking for early stage investments, trying to replicate what we all fondly call the Silicon Valley model of entrepreneurship. And that's when the venture capital fund regulations were introduced in 1996. And yes, the regulations continued to remain in existence, though the industry changed quite significantly over a period of time. And obviously new asset class like private equity, pipe funds, and other more sophisticated asset class started being introduced. But the regulatory framework for some reason remained in kind of static with venture capital fund, and that's where I think SEBI as a regulator realized that there is a need for a complete overhaul of the regulatory framework to basically give recognition to certain new asset classes, including like real estate funds and several others, which the original regulations were not designed. And they started this whole exercise of relooking at the venture capital fund regulations sometime in 2011. A lot of homework which went in, came up with a draft set of regulations in August 2011. The first draft obviously evoked a very strong reaction from the industry. SEBI, to be fair, and as a regulator in a more matured manner, accepted feedback from the industry for making the regulations not only achieve the objective of SEBI in terms of investor protection or otherwise, but also make it industry. And the culmination of all of this is the new alternate investment fund regulations that we have now. And I think to be fair to SEBI, I think it's a very good piece of legislation which in my view will serve the purpose of creating a growth for the industry over the years to come. And that is where I'm very optimistic that this will create a greater platform for people to explore fundraising in India, create new products out of it. Moving on to the, I think we structure the, and I think one of the main objectives of the regulatory AIF as a regulatory framework was primarily to contain what SEBI viewed as a systemic risk which they could create to the industry out here. And that's what the objective has been laid down by SEBI, that it is essentially one, to regulate unregulated funds, and we'll come to some of those things as we go along the presentation, with a view to assess systemic risk and hence the systemic stability in the economy, increase market efficiency, and at the same time encourage the formation of new capital with consumer protection or the investor protection. So this is the objective with which the new AIF regulation was really formulated. If you really look at the scope and applicability of the regulations, I think it is pretty interesting situation that arose, that what happens in the transit, because we had the earlier regulations which really dealt with venture capital funds. Several funds were launched or in the process of raising new capital within the existing structure. And it was confusing initially as to how would these be grandfathered. I think the AIF regulations very clearly now lay down that all existing funds which have been launched under the venture capital fund regulations will be allowed to continue to operate under the erstwhile regulations, and will also be even allowed to raise more capital under the old regulations to the extent of their targeted corpus. They will not be allowed to increase their targeted corpus beyond what was originally envisaged, but they will not be forced to register themselves as AIF. So that, I think, gives a great relief to funds who were at different stages of fundraising, and they will not be compelled to really register as AIF. Yes, voluntarily they may have an option, subject to the consent of 2/3 of their investor approving it, to register the fund as an AIF, but it is an option and not a mandatory requirement to that extent. The other important aspect is, under the earlier regime, an unregistered structure was something which was allowed to exist without being registered as a venture capital fund. And there were private equity funds and some real estate funds in the past which operated as an unregistered trust. The new regulations now make it very clear that any private pool of capital today which is existing as an unregistered vehicle will be mandated to register with SEBI as an AIF. They have been provided up to 6 months to seek this registration, and SEBI may extend it for an additional 6-month period. So it gives them a flexibility, but it is now mandatory for all of them to be registered. No new private pool of capital will now be allowed to continue to remain unregulated going forward. So I think this is an omnibus regulation now for regulating all alternate investment asset class to that extent. Moving on from there to what is an alternate investment fund and the definition of AIF. Basically, SEBI has defined AIF to mean any fund which is established or incorporated in India in the form of a trust or a company or an LLP or a body corporate. So the form of vehicle now can be between a trust, a company, an LLP, which is a new introduction, or a body corporate, which may be falling outside of the other three, and there are essential characteristics of an AIF. One, it is a privately pooled investment vehicle. So there has to be, the spirit is that there has to be pooling of investments coming in from Indian or foreign investors. So it need not extend to all foreign pools which are not established in India, but Indian pools which raise money whether from India or overseas will be covered within the definition, and that will be investing in accordance with a defined investment policy for the benefit of the investors. Second, mutual funds and collective investment schemes will not be covered within the AIF. So if I am already registered as a mutual fund or a CIS, they will be excluded. And also they have created certain additional categories which will be excluded. So the way the scheme will now operate is, this becomes an omnibus regulation for regulating all private pools of capital other than mutual funds and CIS or under specific categories, and all of them will now be required to be registered with SEBI as an AIF. SEBI obviously, when was evaluating the AIF regulations in the original draft, came up with certain 9 different categories of funds which need to be operated, or you had to classify yourself into one of those categories. And that became extremely restrictive, and the industry pushed back that one cannot use such a straight-jacketed approach of regulating an alternate asset class. And SEBI, recognizing the need, has now agreed that we will not force you to categorize yourself into one of those 9 strategies. We have broadly now covered them into 3 broad categories, which will be category 1, category 2, or a category 3 AIF, and I'll come to that separately. But at the same time, they've retained some characteristic that if you could be a debt fund or a hedge fund or a fund of fund is the new category which has been introduced. So there are certain categories which are specifically recognized, but all of them have to necessarily fit within one of the 3 broad categories to that extent. And a typical structure, without going much into detail, you have the AIF, which could be a trust, typically would have a manager which would be managing the assets, and the fund, basically it could be a scheme under a trust as well. Multiple schemes can be done, and that invest, or can be an LLP with an investment manager or a managing partner, or could be a company with different classes of shares. So you have a choice as to how you structure your funds. So coming to the broad categories of alternate investment funds, category 1 AIF, the way SEBI has looked at category 1 AIF, these are funds which have a positive impact on the economy, and these are categories where SEBI may want to provide certain specific directed incentives, and to that extent they will all be treated as category 1 AIF. And what currently is covered within the category 1 AIF is a venture capital fund, a SME fund, a social venture fund, and an infra fund. It will basically be, you could add more categories, SEBI can add more categories, but at this point these are the 4 broad categories which have been included under category 1 AIF. The requirement is, of course, it has to be a closed-ended fund as a category 1, and it is not allowed to really leverage or engage in borrowings to that extent. So a category 1 AIF is something which will also be given concessions or incentives, and at this point these concessions and incentives are the same which were earlier available to venture capital funds, have now been extended to all the category 1 AIFs to that extent. The category 2 AIF is essentially a fund where there are no investment side restrictions that SEBI is going to impose. It will be funds where you may be allowed to define your investment strategy, but the focus has to be primarily on unlisted investments. But within that, you could structure it as a private equity, you could structure it as a debt fund or a real estate fund, or any other strategy, but they will not be offered any incentives or concessions to that extent. Again, these will have to be closed-ended, and also they will not be allowed to undertake leverage to that extent. So both category 1 and category 2 AIFs will not be allowed to engage in leverage, which is important to note out here. And the third category, I think this is something which seems to hold a lot of promise, and will see a lot more growth of this new asset class, which is primarily a category where hedge funds or any other complex strategies, funds with complex strategies, will be allowed to operate and register themselves at SEBI. And we have already seen a fairly significant amount of interest coming in from advisors and GPs, as we call it, general partners in category 3, to design new strategies. So for example, if I'm primarily looking at strategies targeting at listed investments or hedge fund strategies or derivatives, a lot of them will now fall under category 3 AIF. Category 3 AIF can be either be open-ended or closed-ended. So there is no mandatory requirement for them to be closed-ended. And SEBI may issue separate directions to these categories of AIF depending on their strategy that they would want to. So this is where SEBI has retained certain discretion to come up with additional conditions that they may prescribe over here. I think besides the asset side restriction, which are fairly limited now to, especially in case of category 2 and category 3, I think some of the features which really now are important from an AIF perspective, the minimum investment. And unlike the earlier regime where the minimum investment was rupees 5 lakhs for any investor looking to invest in a venture capital fund, the minimum investment has now been raised to 1 crore rupees. And this has obviously, in the initial reaction from the industry, there was a significant pushback, and obviously there are certain business models which may find this too restrictive, especially those who are looking at a very wide retail participation. But I think in the long run, considering the risks associated with an alternate asset class, I think it is being viewed by more matured players as something which will help the growth of this industry in the long run. The second important change is the minimum corpus. So while earlier the minimum corpus was 5 crores of rupees for a venture capital fund, that has now been raised to 20 crores. So a fund has to have a minimum corpus of 20 crores. Earlier there was no mandatory requirement for a sponsor commitment or a GP commitment, as they call it. The new regulations now impose a GP commitment of a minimum of 2.5% of the initial corpus, and this initial corpus will be viewed as total corpus of the fund, or rupees 5 crore, whichever is less. So the GP commitment on a general basis, a minimum 5 crore, if you are looking at a fund size in anything in excess of 50 crore, is now becoming mandatory in some sense. And this shows, from a SEBI perspective, a skin in the game, and only more serious players would really come into this business, is what the regulators expect. And this cannot be brought in, this has to be cash commitment, it cannot be brought in through waiver of management fees or otherwise. So this is something which is a very important development for the regulations out here. In case of category 3, the sponsor commitment is increased to 5% or 10 crores. Considering that these would be more higher risk kind of strategies, the sponsor commitment has been increased. For both category 1 and category 2, the minimum tenure for the fund has been fixed at 3 years, whereas for category 3 there is no minimum tenure that has been fixed. So minimum tenure is the fact that you cannot raise funds with a commitment of less than 3 years in category 1 and 2. You can continue to have multiple schemes, so you can get an umbrella registration as an AIF and then continue to launch new schemes by filing information memorandum. It's also now making it more conducive for listing of these units, and we might see some of the alternate investment fund units being listed. There are also certain benefits like QIB, qualified institutional buyer status, which has been offered to all categories of AIF, so that will allow them to participate into different IPOs, for example, is one as a QIB or a preferential allotment. So that's one benefit which all the AIFs are basically being offered under this. Under category 1 and 2, I think one of the conditions which is on the investment side, that they will not be allowed to invest more than 25% of their investable funds in one single investee company. And that is something which is basically to facilitate risk diversification, and it is not a project specific or a single investment specific vehicle. For category 3, this limit is 10%. So that's one additional investment level restrictions. And you may be able to, generally the minimum fund tenure is 3 years, you may be able to extend also, but it does not put any cap on the maximum tenure, so you can have a normal tenure of 8 to 10 years, which is quite common for private equity funds. But you can also extend the life of a fund by 2 additional period of 1 year each, which is also allowed under the regulations. You need a consent of the 2/3 of your investors to come through for that. But that's something which is now prescribed under the regulations. Where can these AIFs invest? They can invest in investee companies which has no restriction in terms of definition. You can invest for category 1 in venture capital undertakings which are unlisted entities which are engaged in production or services or otherwise. So it's a very narrowed down definition of, but it is only applicable to category 1, or even SPVs, and that is relevant for infrastructure and other funds where my operating company may be one step down and I may invest through special purpose vehicles to that extent. And now, of course, LLPs are also something which has been introduced as an eligible category for investment. So that is something which would give flexibility on structuring of investments. They have, I think, what is important also throughout the regulation is the introduction of a fund of fund categories. And this is, again, very important, considering that the 1 crore limit could limit the ability of an investor to achieve a diversification of investment. As compared to that, a fund of fund may be able to make allocations more efficiently. So investors who are coming in with a 1 crore of commitment into a fund of fund, which can in turn invest in multiple alternate asset fund, can achieve the risk diversification to that extent. So that's something which is welcome again by the industry, and we'll see more products coming up on that side. For category 1, which it continues, I won't go into more specifics here, but the most conditions of a venture capital fund regulations of 2/3 being in unlisted entity and only 1/3 being allowed in listed entities or debt or preferential allotment. Those conditions continue to remain applicable for venture capital funds which are under category 1 AIF. For infrastructure funds, minimum 75% of their corpus has to be in companies which are operating in infrastructure space. Social venture fund, which falls within again category 1, at least 75% has to be in projects which are in the social venture or has a social impact. So which is, I think, a new category that SEBI has recognized, and they have got very positive feedback from players who are looking at creating platforms for social relevant projects to that extent. So those are prescriptions which have been made under the category 1 AIF to that extent. I won't go into the specifics of each of this, it's there on the slide. I think category 2, as I mentioned, Unlisted securities has to be the primary objective. It cannot do the borrowing, which I have already touched upon. It may engage into hedging strategies. So today, especially when you have foreign investors coming in, you may want to engage into certain hedging products at the fund level that may be permitted subject to guidelines which may be laid down. And also they have created kind of a carve-out that if these funds are looking at investing in SME companies which are listed, the biggest challenge in the past has been that being a listed entity subjected to SEBI regulations in relation to insider trading. How does a private equity or a venture capital investor undertake due diligence on these companies, because you do invariably end up coming in possession of unpublished price-sensitive information. And that is where I think SEBI has now created a carve-out by saying that these categories of AIF will be exempted if they are investing in SME companies to that extent. I think category 3 is for any listed, unlisted derivatives or complex or structured products. So you design your strategy and can fall within that. The fund of fund, which is under AIF 3 category, can invest in any category 1 or a category 2 funds to that extent, and they are allowed to engage in leverage. So that is something which is permitted out here. So I think I've already touched upon this on what happens to existing VCFs or unregistered pools of capital, so I won't repeat it out here. But I think also what is relevant and important is the fact that the tax pass-through, and one of the biggest challenge for the industry has been the fact that there has not been any regulation which gives them an assured pass-through as a venture capital fund or a alternate investment fund. What the new budget which has been recently introduced have now done is reinstated a pass-through for category 1 AIFs. So any category 1 AIF will now be eligible to claim a pass-through under section 1023 FB, whereby the fund will itself not be subjected to any tax, and only the investors will pay tax in their own hands. And this is something which is extremely important for the industry, because a huge amount of tax litigation has really emerged since 2007 when the law was changed, and that is something which I believe would go along in at least facilitating a clear tax position. Unfortunately though, for category 2 and category 3 AIF, they will not be covered under the assured pass-through of section 1023 FB. So they would still need to continue to rely on the general taxation of trust, the specific determinate trust provisions, and so they may continue to remain exposed to a certain degree to the tax litigation risk. Though when we have interacted closely with SEBI and some of the other regulators, we understand that the CBDT is willing to come up with something more clearer for the other two categories of AIF, that so long as the tax has been paid at the fund level, the investors will not be harassed and will not be forced to pay taxes and claim refunds at the fund level. So I think that is some hope that we have for the category 2 and category 3. In addition to the investment conditions, SEBI has also, for investor protection purposes, come up with certain governance standards as to where investor consents will be required. So there has been an introduction of situations like key person events, change in control happening at the investment manager. All of that would require a consent of the unit holders, and this is basically split between a 2/3, which is 66.67 or 75%. So certain matters like in-specie distribution or early termination or extending the life will require 75%, whereas change in investment strategy or extension within the 2-year period will be covered within the 2/3. So that gives investor protection that the general partner or the manager cannot unilaterally change the fundamentals of the product without the investor consent. Of course, valuation has been prescribed. It has to be done by an independent valuer. It may need to be, generally I'm required to do it at least once in 6 months, but with the investor consent of 75%, I can reduce the frequency of valuation, which may be relevant for certain illiquid asset class, including like real estate to that extent. But category 3 will need a more regular NAV reporting to that extent. There are certain reporting standards which have been prescribed by SEBI for the funds to report their performance to the investors. Generally, annual report is something which has been mandated now. And plus, in case of category 3, there has to be a quarterly report which has been mandated. And that is something which will make sure that the investors are well informed on some of this. The risk disclosure standards have been now captured by SEBI in the regulation, so you need to ensure that you are disclosing risks appropriately to the investor. Also, any related party transactions between the manager and other service providers which may give rise to any conflict of interest, those need to be disclosed. Also, material liabilities that may arise in terms of any disclosure in relation to sponsors or any other related entities, or if there has been any breach, all of those will now require to be disclosed, and it's part of the obligation of the general partner and the investment manager. So investor protection has also found its presence now in the new regulation as compared to earlier regulations, which were very light on prescribing some of these conditions. I think with that, I think I'll just conclude my presentation out here, and maybe be willing to take a few more questions. But overall, I think it's a welcome move on part of SEBI and generally for the economy to have these new set of regulations. And it will really go a long way in creating and strengthening this asset class to that extent. So I think with that, I'll close my session here, and we'll be open to take a few questions from the audience to that extent.
Hello, Satish from Altveda here. Any questions from the audience? I already have 3-4 with me. Any questions from the audience? Please start. Okay. In the meantime, I will ask 2-3 questions that have already come. Okay. One member, attendee Kannan Ramdas, he would like to know what are the professional qualifications which are required for the key person. And I may just add academics as well as work experience wise. If
SEBI has in fact prescribed certain eligibility criteria for a sponsor, and I think while the regulations don't specifically go into whether it is only at the sponsor, but it is assumed it will apply to the team, management team. And one of the conditions is that at least 5 years of experience in the financial services space is something which is necessary for sponsoring an AIF. And to that extent, they have retained flexibility that it need not be any particular profession only. It can be any experience in the financial services space, which could be asset management, broking, or any other form of experience. Having said that, my understanding is going forward, SEBI has reserved its discretion now, and there will be a more higher scrutiny which would be applied to applicants in terms of where SEBI will look at it not just pure professional qualifications, but also the fact that what kind of experience that the people or the sponsor has or a key management team has, and whether that is commensurate with the strategy that you are proposing to launch under AIF. So while the regulations may not go into great depths of prescribing a specific eligibility or educational qualification, it will clearly be exercised, in my view, as a discretion by SEBI while approving any AIF.
I will come to a specific technical question. It basically is out of queue, but maybe will be of some interest to many attendees. It says, how will a tax be borne by a fund in case of a category 3 AIF which is indeterminate and open-ended, especially in cases where the derivative positions are open? This question was asked by Mugdha Sahal.
Okay.
Yes, I think,
to
to
be honest, that's the question that we have been currently also grappling with for a few of our clients who are obviously very excited about the category 3 AIF open-ended structures. And to that extent, what would be the tax position? Obviously, it's a little more complex than what I could probably make it out over here, but in a simple situation, if a trust is an indeterminate trust, and more likely when I'm looking at derivative tradings, it is quite likely that the trust will be treated as a business trust. And under the current provisions of Income Tax Act, it provides that any business trust will be subjected to tax at the trust level. So unlike a specific determinate trust where the discretion lies for the assessing officer to either tax the trust or the trustee or the beneficiary, in case of a business trust, it is clear that the tax has to be paid at the trust level, and the tax has to be at the maximum marginal rate, which is applicable to an individual. So assuming it is a 30% tax. One position is very clear under law, that a trust is not a separate assessable entity. So there can never be two layers of tax. So even in an open-ended structure, if a trust has paid tax, technically there is no further tax to be paid by the beneficiary. The challenge which comes in an open-ended structure, that your investor base may change from time to time. And how do you provide an exit to an investor during the financial year where you may be required to pay advance taxes on a quarterly basis, and you would offer it to tax, and at the end of the year, when I do get an adjustment or a credit, the investor base may not be the same. And I think that honestly there is no straight answer to that today. Commercially, people have accepted that people who either I make my tenure or the fund open-ended from a year-on-year basis, rather than keeping it open-ended during the year, because then at least this issue may be resolved, that I will always have an investor exit at the end of the year and not during the year to that extent. But obviously it's not the solution in its finality. People have internationally, people do use mechanism like equalization structures for achieving certain equalization between investors who are existing and a new investor coming in. But purely from a tax perspective, we will need to deal with this in a manner where either I pay the full tax, and the investor at the end of the year, if he believes that the tax on his income, and I can give a statement as a trust to the investor at the end of the year, that if there has been any losses or others to be set off against the original, he may claim individually in his return. But it's not going to be that simple administratively to achieve that. So it's, in a nutshell, a complex situation under the current tax position.
I will come to another question by one Mr. Govind Rajan. I will combine separate questions for convenience. It says, can a sponsor of an AIF, if that sponsor is a RBI registered NBFC, does it have to take a permission from RBI or SEBI for that matter? Second related thing is, can the AIF sponsored by RBI invest by RBI itself, invest in foreign securities, maybe it's SBI caps or something,
Yeah.
invest in foreign securities? If yes, should we get a prior permission from RBI?
Okay. So I think coming to the first question on whether an NBFC can sponsor an AIF and whether it requires an RBI consent. The position under law is, from a SEBI perspective, an AIF regulation perspective, there is no prohibition on an NBFC sponsoring an AIF and no precondition that it has to obtain a prior RBI approval. So from a AIF regulation perspective, no such consent is necessary. Nor in our understanding for NBFC, depending on the category of NBFC that you are, there is no restriction on the nature of activity that you can carry out. So it's because your NBFC categorization is slightly more complex, so I cannot give a very generic answer. But from an NBFC perspective, as such, there is no prohibition. Having said that, based on our past experiences, when an NBFC wants to sponsor an AIF, SEBI does internally at times refer matter to RBI to obtain a no objection certificate. So it is not necessarily the applicant which approaches RBI, but SEBI as a regulator, before handing over any license to an entity which is otherwise regulated by RBI, seeks to obtain an NOC from RBI. And that process may still be followed when a sponsor of an AIF is a NBFC. Coming to your second question, and my understanding seems to be the question is around whether a domestic AIF will be allowed to invest overseas, because RBI cannot sponsor an AIF and would not generally. But can an AIF invest overseas? Yes, today the regulations do not put any prohibition. Even under the existing venture capital fund regulations, within the 1/3 of its corpus, they were allowed to invest in foreign securities. The new AIF also allow them to invest, but RBI will need to come up with certain specific notifications, especially for Category 2 and Category 3 AIF, as to what would be the quantum and what would be the process to be followed for investing in foreign securities. But principally, I don't think there is any restriction on investing in foreign securities within the given cap.
Which will be there in many people's mind, though not so technical as the others. The question is there any exception to the net worth criteria? That is the way the question is worded, but maybe it might be the contribution of rupees 1 crore for an individual member. Can I, with rupees 25 lakhs amount, invest in an AIF by forming a LLP or any other way? Here I will just add an employee or a director with 25 lakhs can invest, but I will leave the question now open to Mr. Siddharth Shah.
Okay, so I think the simple answer first, that the only exception to the 1 crore rule as per the AIF regulation is available only to employees of an AIF, where the limit has been reduced to 25 lakhs. All other categories of investors in AIF, irrespective of their category, will be required to have a minimum commitment of 1 crore. Whether there would be structures which would be worked around to facilitate lower capital, my understanding is, going by the spirit of the regulations, if I'm looking at creating a structure where I'm doing any form of pooling from multiple investors, so what you suggested, that can I have an LLP where 4 investors can come in with 25 lakhs and then the LLP becomes a contributor into an AIF for 1 crore, would always run the risk of this LLP itself being viewed by SEBI as an AIF independently. And that is where you will always be faced with the issue of the SEBI coming back and clamping down on some of these structures. At the same time, yes, if a fund of fund is something which can be structured, and there may be that would be a more elegant way in my view to really achieve the diversification rather than trying to structure it through intermediate holding structures. But I think as things evolve and as the AIF regulations evolve, maybe newer structures including PMS or other structures may come up where you might be able to achieve some diversification.
I will repeat another question by Neeraj Agarwal, who had raised the question of this exception for 1 crore. His next question is, which is related to the earlier question, is in case an investment is in AIF is done through an LLP. Suppose the LLP is formed with 5 members with 20 lakhs each. Can the LLP first of all invest? Second, whether the AIF will recognize each individual member of an LLP as a beneficial owner to the extent of its share in LLP in case there is a dispute.
So I think I partially answered that question that in the model where I am pooling multiple investors at an LLP, the LLP itself could become or be viewed by SEBI as an AIF. And now that the AIF definition is broad enough, you would be faced with the same challenge that an AIF LLP itself may need a registration, and hence 1 crore becomes minimum to that extent.
I will raise another question, this time asked by Nitin Gupta, and merge it with some other question. First is, can commodities trading be part of category 3 AIFs, and whether would a category 3 AIF be allowed going forward to trade in foreign securities such as Dow, futures, etc., which is currently under question regarding $2 lakh limit for a person?
Okay, so I think the first question, again, in SEBI's view itself and their understanding is a gray area. But our understanding is because it falls between 2 regulators, which is the Forward Market Commission, which regulates the commodities trading, and SEBI as a securities regulator. So at one level, the asset class is something which is regulated by FMC, and hence SEBI has no jurisdiction over it. On the other hand, the pooling part of it, which has an element of investor protection, is something which is regulated by SEBI under AIF. And the way AIF today is defined, any form of private pool, irrespective of where it is being deployed, needs registration with SEBI. And we've had interactions with multiple players who are really looking at some of these products. So our understanding is it should be possible for a category 3 AIF to invest as a part of its strategy into commodities. Though I would warn that there is a gray area, and an FMC which has specifically said that they discourage PMS products for commodities trading, could view this as something which is a workaround or may view this negatively and runs the risk there. But otherwise, from an AIF regulation perspective, there's nothing which prohibits them from investing in some of these products. As far as foreign investing is concerned, my understanding is that SEBI will be cautious on allowing these category 3 AIFs to engage in forex trading, foreign securities trading, or because one, it's not SEBI's mandate essentially from a exchange control perspective to allow or disallow. It is an RBI prerogative to do that. And secondly, I think SEBI as the first step may want to put certain caps on how much can an AIF invest in foreign securities. So that's something which will only evolve and may come as a prescribed condition part of your registration. RBI will be very uncomfortable allowing AIFs as a workaround to the cap of 200,000, and they have always basically retained that this 200,000 is for individuals to invest overseas, and no other structure which pools these people into one except mutual fund will be allowed to invest overseas. So we may need to see how the law really evolves around that.
Could you describe how an owner can come into an AIF fund? Question asked by Vijay A.
So foreign investors, as far as AIF regulations are concerned, are permitted to invest, and it is SEBI regulation which allows them. SEBI has no power to really create any exceptions outside of the FDI policy. So today, the FDI policy clearly provides that any foreign investment into a domestic trust will require a prior approval of FIPB. So it will only be permitted, in our view, with the prior approval of FIPB.
Then there is one question which says, can you clarify what is corpus? Question asked by Kannan. I would just like to mention the word corpus has been specifically defined in the AIF regulations, but I would like to modify this question a little bit. Suppose a fund has been launched which says that it intends to raise, say, 500 crores, but there is a green shoe option of, say, 200 crores, and this is mentioned. Then whether that particular fund which is presently covered under the VCF regulations will be allowed to raise money up to 700 crores, that is inclusive of green shoe option, or only the initial corpus of 500 crores.
So the way I read it, and obviously regulations are not specific on this issue, but going by what SEBI has laid down, that my targeted corpus would in my assessment include not only the original but also green shoe, so long as it has been specifically disclosed in the offering document. So in your case, 700 crore is what is permitted with say 500 crore with 200 crore of green shoe.
Okay, keeping track of the time, I will just ask one last question, and this is, how can a category 3 structure could be used for an offshore debt investments in India, and what would be the minimum contribution required by the manager? Question asked by Chirag Pandya.
So I think the question is category 3 AIF. First of all, for them to accept any foreign contribution, as I mentioned, they will need an FIPB approval. Depending on the strategy of the AIF, it is the DIPB's discretion or FIPB's discretion to allow a foreign investors to come in. If my strategy is debt fund, and I'm looking at really getting a foreign contribution, I may run the risk that FIPB may not permit it or may permit it with conditions. So it is something which will have to be seen as to how FIPB views this as an indirect form. Like today, NBFCs are allowed to do lending, even though NBFCs have full contribution coming from non-residents. And in some sense, drawing a parallel, RBI or FIPB to that extent may allow. But it is still too early to say how and what conditions they'll prescribe on that.
Any exemptions for family offices within India?
Yes, so I think amongst the exempted categories of AIF, family trusts, certain employee welfare trusts, SPVs or vehicles which are regulated by other regulators are specifically exempted from being regulated as a AIF. So they fall outside of the definition of an AIF. So it's not really linked to the office of management, but if you create it as a family trust, then it could fall outside of the AIF.
Just one last question. The valuations that are required to be done for category 1 to 3, especially for the real estate asset class, are they needed to be done by only government approved valuers?
No, it basically the regulations prescribe that it is independent valuers. So it should not be a valuer linked to the sponsor of the there is no requirement of a government approved valuer only.
There is one attendee who wants to raise the question verbally, Ms. Ranjana Pandit. Ranjana, can you please ask the question? Ms. Ranjana Pandit, can you please ask the question? I think she is not there right now, but we will try to look at how we can resolve her query. Are there any more questions from the audience, please? We are nearing the end of the seminar anyway. Okay. I would now like to request Loknathan to say a vote of thanks to our esteemed speaker.
Thank you so much, Satish. Thank you so much, Siddharth. It has been a very nice sessions. Actually we have got and discussed about this subject post SEBI had come out with this alternate investment fund. A lot has been discussed, and a lot of people have said, is it only a name change? Is it a dramatic change which has come up? And hearing you, we have seen that it has opened up a complete new investments to come into this sector. As the name suggests, it's a new alternate investments fund. It has actually opened up the sector with wide options, not being a specific venture to come out with some new categories. And this category 3, as you have answered also the questions, and we have seen that the category 3 has been a very innovatively structured to incorporate a lot of new things which could be imagined, thought of in future, and SEBI should look at that. So that's a very welcome initiative by SEBI. And we have, as you discussed, we saw that it has been made more investor pro, wherein the compliances are there, the reportings are there, the reporting of 75% or your annual reports and quarterly reports. These kind of incorporations are really a very positive move, and professionals like you who are actually guiding the industry and making them understand that how this has to be put in place will be really great, and the kind of service that you provide are really great, Sid. What I wanted to ask is this 1 crore, which has been, said, time and again we find that people say, okay, 5 lakhs, it has gone up to 1 crore. Now, one angle when we see that it is for a matured investors to come into the play. But are we saying that one who has 95 lakhs is not given an opportunity to make money out of this investments? Now, how do you look at it, Sid? I mean,
See, I think it's very interesting, and in fact, we had the benefit of having a long interaction with SEBI on this specific issue when they were formulating the regulation. And in fact, one of the proposals which the industry has given was rather than forcing an investor to make a minimum commitment of 1 crore, a more appropriate approach which many matured markets have taken is to define a sophisticated investor based on a network or other tests, and then leave the discretion to him to make the allocation. And that I think would have probably addressed the issue that once I establish that he is a sophisticated investor, I may be able to take even 20 lakhs, 25 lakhs or 1 crore. Unfortunately, I think SEBI and the regulator still believes that this asset class needs to mature. And that approach today in an Indian context to assume that anyone who puts a 1 crore or has a certain network is a sophisticated investor to understand the risks of investment. They were not too sure whether it can be applied in an Indian context. Having said that, I think there was also some assurance as that
the
as
regulations
the regulations
and maybe
mature,
as SEBI
and maybe as SEBI experiences
how these
how
regulations
these
unfold
regulations
over a period
unfold
of time,
over a period of time,
they may be willing to
they may be
really
willing to really
change the approach
change the
in some
approach
sense
in
and
some
maybe
sense
go with
and
what I
maybe
just
go with
mentioned
what I
and
just
leave the
mentioned, leave
minimum
the
commitment
minimum
decision
commitment
to the investor,
decision to the
but
investor,
define who that
but
investor
define who that investor should
I'll
be.
just like to say said that this question was asked by my professor because he says I know the market, I understand it, but I never made 1 crore to invest. So
and it's
And it's
no, I fully
no,
agree.
I
And
fully agree. And
honestly, if you look at
honestly,
in
if you
the
look at
Indian
in the Indian
context,
context,
while the
while the
regulators
regulators may have viewed
the retail
the retail
participation as they
participation
view
as
it
they view
as
it
something
as something
less
less
desirable,
desirable,
if you look
if you
at the
look at the
development of the
development of the
industry over the
industry over the
last
last
8-10 years,
8-10 years,
I think
I
one
think one
significant
significant
contributor
contributor
has been
has
this
been this
new
new
retail
retail
segment, which
segment,
has
which
really
has really
brought this
brought this
alternate
alternate
asset class
asset
to
class
the
to the
forefront,
forefront,
and where
and
SEBI
where
is now
SEBI is
obviously
now
looking at
obviously
it.
looking at it. So a balanced approach where you are encouraging the industry at one end by allowing them and also encouraging them to develop new products, have the flexible regulations. On the other hand, from an investor protection perspective, rather than putting a 1 crore cap, it would have been better. Today as a 1 crore, even if I have 1 crore, I may not want to put my entire 1 crore into one AIF. I am still a HNI by Indian standard, but forcing me to put my entire savings or my corpus into 1 or 2 AIF is not desirable from a risk diversification perspective. But I think I see hope that somewhere along the line SEBI will look at the issues and maybe use a slightly different approach. I would not discount it, but at this stage they didn't want to complicate life too much and sit on a judgment whether every 1 crore investor will be sophisticated or not. So they found a short-term solution right now to address their concern, but in the long run I believe they would be open to address some of these issues as well.
One more thing that I wanted to ask is, I mean, as these things mature, as AIF is maturing, when can we see these kind of things getting traded on the exchange? I mean, I don't know. That has to be the future, because when we want that this has to be an alternate investment, this has to mature the way our market has actually matured. You know, the way the stock market has taken shape when it was on the counter. Now on the exchange we see. You know, it could be how many years, or do you think?
Yeah. See, I think that's a very good question.
Well, I think that's a very good question. And if you look at the erstwhile VCF regulations as well, the regulations allowed venture capital funds to list their units after a period of 3 years. No one ever listed it. And obviously it was not so much that the regulations prohibited it. I think the market, including the regulator themselves, were not sure as to how this asset class can be listed and how the trading can be carried out. But having said that, with a lot of homework that has gone in by the regulator in formulating these regulations, this asset class itself has matured to a level where it is not as novel in terms of or unexplored as it was maybe 10 years back. I would not be surprised that you might see listing of these asset class over the next, I would go as aggressive as saying over the next 2 to 3 years, you may actually start seeing, especially category 3 kind of asset class may actually look at listing more sooner than maybe category 2 or a category 1. And I will not be surprised that it could happen over the horizon of next 1 to 2 years.
That I think we can come to the end of this webinar, and it was great to have Siddharth you and address a lot of issues. I'm sure all the participants here would have achieved a lot of knowledge, and we foresee a lot of things to happen in this sector, and there will be frequent of this discussions, and we would really like to have Siddharth to come and join us in many of such sessions and address a lot of queries. Thank you so much for all the people who have joined, who have raised queries. If you have any further queries, you can mail us at the Arthaveda email address or Nishit Desai's address. We will be happy to give you all the offline answers to it, or those which we couldn't take it now for the time constraint. Thank you so much. Thank you so much, Siddharth. And
Well,
great.
Thank you.
Thank you. Pleasure.